Welcome to RodneyABrooks.com. Today we're talking with Mitch Katz, partner with Capital Associates based in Bethesda. And actually, I should have started with basics, the difference between a traditional IRA and 401k.
I was going to talk about that,
So,
the difference.
and why you might want to convert. Okay,
So really simple. 401ks and traditional IRAs have the same tax treatment, and oftentimes when you leave employment or you're done working, a 401k becomes what's known as an IRA. A Roth IRA is a completely different entity or animal. A traditional IRA, at the end of the day, when you hit 72, it's called required minimum distributions. You've never paid taxes on those dollars, and you're required to take the money out, and it's taxed at ordinary income. Period, hard stop. That's a traditional IRA, and a 401k is the same thing. A Roth is you've now paid the taxes. You've never got a deduction, or you've already paid the taxes on that money. That money, like the traditional gross tax deferred, you're not paying the taxes on the growth. On the withdrawal, the difference is on a Roth, you're paying zero taxes. So let's just say you have $100,000 in both accounts, right, a traditional and a Roth, and I'm just making this up, but you're in the 30% tax bracket. You withdraw 100% of your traditional IRA, 100 grand. IRS gets 30,000, you get 70. In the Roth, you've already paid those taxes, so when you withdraw that $100,000, you put that $100,000 into your pocket. So the Roth, in theory, has more money. Going back to his original question, though, is you had to pay those taxes in the beginning. So which is best moving forward, and it's different for everybody in each situation. But thankfully, we have software that can help us figure that out.
Now, one good thing now is that they have Roth options in many 401ks.
Yes.
So you don't. So you're worried for younger people. They're worried less about having to do a conversion because they can actually save.
Absolutely, you know? It's a big deal. It didn't exist a few years ago, or it existed and many plans didn't have it. Now it's in almost all of them, and it might even be required now. So long story short, now they give you the option. Do you want your money in a Roth 401k or a traditional 401k? What's also great about that is, as many people know, there's Roth contribution limits, meaning if you make too much money, you can't contribute to a Roth, and oftentimes that Roth contribution is 5 grand, 6 grand, whatever it is. So now you can get the maximum 401k contribution into it each year. So right now that's $21,000. For people have catch up, it's even more, which is $5,000 a year. Long story short, you can get large chunks of money into a Roth and not have to worry about those conversions. What are you giving up for that? Well, you're not getting the deduction when you actually make that contribution. So it costs you a little bit to put the money into the Roth, but the benefit far outweighs that if it works in cash flow, right? Like, not everybody can afford to do so, but if you can, cash flow is king, and if you're able to do that, a Roth 401k is the best way to go.
Okay, so do you generally recommend, in terms of allotment, what percentage traditional when it comes to 401k versus Roth?
If a family or an individual can afford it from a cash flow perspective, we would recommend all of the money into a Roth 401k. Now, if you don't have the cash flow to do that, that's when we start saying, well, get as much as you can in there, and then the rest into the traditional 401k. So it really comes down to, what does your day-to-day, your month-to-month, year-to-year cash flow look like?
Okay, so let's talk about basically investments in long term and volatility now. And I mean, part of when market is volatile, part of your job is sort of psychologist and hand-holding. I mean, because that's when people call you up worried about their investments. So what, when markets turn volatile, what happens with financial planners?
Yeah, well, obviously the phone starts to ring. But, the market's always volatile. There's always something. Right now we have a presidential election, so there's a lot of talk about that. That'll end. Then the next thing will happen. I remember Greece was unable to make their payments and they were going to get kicked out of the euro or the Brexit or whatever it may be. There's always something. There's always volatility. And that's sort of the price you pay in order to have the dollars grow. And so there's something called an Ibbotson chart, or they used to call it an Ibbotson chart. And it overlays large cap stocks over small cap stocks over bonds, inflation, and then world events. And essentially, we call it the Pepto-Bismol line. The stock line goes like this. The bond line goes like this, but over the end of it, the gap is that much. And so you have a lot more money in the stocks, but it's a much more difficult ride to get there emotionally for people.
Yes, and historically, stocks have outperformed every other investment years and years.
Oh, yes.
Years,
Oh, yes.
By far.
By far. By
Yes.
far.
Okay, so you talk about election. We got a whole lot of uncertainty in this election, and markets haven't really reacted so far. But that can change, and it probably will.
Sure.
So, what kind of advice can you give to your clients who are worried about the elections, especially the presidential ones, and you'll probably also have the Senate and Congress up for grabs?
Great question. We talk about that a lot. It's on the tips of everybody's tongues, and it's all you see all day. What's really neat is, again, I go back to charts and graphs, and everything's sort of quantified in what we do. We have a chart and graph for everything. Bottom line is this: the elections don't matter. Let me explain what that means. And there's all kinds of numbers to back this up. I had an inkling we were going to talk about it. So off camera, I actually brought, I went to BlackRock yesterday and I printed it out and I have it with me. And I could sort of illustrate it for you, or we'll put it up on the website maybe.
Okay.
At the end of the day, and when a Democrat is in an office, believe it or not, their returns in the market, it's a little bit higher than when a Republican's in the office. And we could probably set up 10 of these interviews and speak for hours on the philosophies of why that is. But it actually doesn't matter. Here's why. Those rates of returns are much lower than if you actually have your money in the market allocated correctly for the whole thing. Going back 100 years, which is about what we have for the market, a little bit less, your annualized rate of return on a growth portfolio is 10.3%, regardless of who's president. And on that chart I just mentioned from BlackRock, literally the line for Democrat and Republican is here. Both are sort of on top of each other. It's very low on the chart. And the rate of for $1 going back, and the annualized rate of return for all of them is up here. I mean, the gap is like this big on a piece of paper. And so what we always tell people is that it doesn't matter. The pundits oftentimes are wrong. They're on TV, they're talking all the time, they have to fill the airwaves. They're wrong often. And so we try not to pay attention to it, because if we followed what they told us to do, we'd all be broke. And that's just sort of news entertainment, and that's great, but the numbers don't support what they say. They don't know what's going to happen. And so the history, the data shows that if you don't pay attention to it and you stay fully invested, built correctly on a growth portfolio, you're going to get going back almost 100 years, it's a 10.3% rate of return. And your dollar invested for, say, only the Democrats or only the Republican, regardless of their rate of return when their office is so much lower, you'll be working until you're dead. You'll never have enough money.